What's up, traders, and welcome. In today's video, we're going to be talking about the business cycle. Now, as investors and traders, the business cycle and understanding which phase of the business cycle we're in can really clue us in as to the sectors of the stock market that are likely to show favor at any given time. Knowing this information can help us to allocate our portfolios appropriately and to better prepare ourselves for changing economic conditions and help inform us as to the likely future course of the flow of funds within the stock market. So let's dive in and learn a little bit more about the business. So the business cycle just refers to the natural ebb and flow of economic growth as measured by the gross domestic product, GDP, right? So there's four main phases of the business cycle, those being the expansionary phase, followed by a peak, followed by a contractionary phase, followed by a trough. Now the length of each phase varies, but typically the expansionary phase is by far the longest, sometimes lasting years and years. The peak and trough are typically pretty short, anywhere from a month to 3 months, and the contractionary phase is usually between 6 months and 2 years. So the expansionary phase refers to times of economic growth as measured by GDP. So usually a GDP growth rate between 2 and 3% per year is considered a healthy level. This is usually accompanied by unemployment hovering around its natural rate of 3.5 to 4.5%, and inflation growing at the Fed's target rate of around 2%. This is what's known as the Goldilocks economy, when everything is going just as it should and the economy is growing but not growing too fast, inflation is growing but not growing too fast, and unemployment is at healthy levels. The peak refers to that time when economic growth starts to taper off. And this is usually in response to inflation heating up. If inflation gets too high, the Federal Reserve is more inclined to raise interest rates in an effort to curb that inflation. This makes it more expensive for businesses to borrow money to fund new projects and generally results in an economic slowdown. The contractionary phase of the business cycle just refers to an economic slowdown. So this is usually marked by GDP growth dipping below 2% per year and is generally accompanied by higher rates of unemployment. Lastly, the trough is just that part of the business cycle where the decline in the GDP growth rate has subsided and economic conditions are generally improving. When we talk about the business cycle, that typically refers to ebbs and flows in economic growth, but the stock market tends to track the business cycle pretty closely as well. In fact, the stock market generally leads the business cycle. So to that end, the stock market is something of a leading indicator of the economy. So while the business cycle may be in its late contractionary phase or into its trough, you're likely going to see the stock market turn up into a new bull market before you see data confirming that the business cycle and the economy has entered a new expansionary phase. Similarly, the stock market is likely to peak and roll over into a new bear market before you're going to get data confirming that the economy has peaked. As traders and investors, we're obviously a lot more concerned about what's going on in the stock market and in financial markets in general. So why is it important to study the business cycle and keep track of GDP when it's not going to give us a heads up as to the future course of the stock market? Well, that has to do with the fact that different sectors of the stock market are going to respond differently to the various phases of the business cycle. So knowing which phase of the business cycle we're in will give us a better idea of which sectors of the stock market we should be looking for new investment opportunities. It's going to help us allocate our portfolio appropriately based on where we are in the business cycle. With that, I encourage you guys to check out the sector rotations video over on the tutorials page at marketbarometrics.com. This is going to give you a better handle of how to use the business cycle to inform your trading in the stock market. But for now, let's take a look at popping over to the Market Barometer, we can get a look at GDP fluctuating. Now, I've zoomed in on the time frame around the Great Recession because this gives us a really good kind of idealized picture of GDP ebbing and flowing around a business cycle and changes in the business cycle. So in 2007 through 2008, mid 2008, you see GDP was continuing to rise. The growth rate in GDP was still up. Early 2008 and mid 2008, you see there's something of a business cycle peak there, where that growth rate begins to decline. And then GDP actually declines through the next several data points into mid 2009. It hits a trough here in quarter 2, 2009, before turning back up into a new expansionary phase. Now you can see that the stock market actually tracked this pretty much in lockstep. Coming up to the technical analysis section, I've pulled up a chart of SPY, that's the Spider S&P 500 ETF. This is basically, we can use this as a proxy for the overall stock market at that time. So you can see the stock market peaked in late 2007, declined all through 2008 and into 2009, bottomed in early 2009, and entered a new bull market at that time, pretty much in lockstep with what was going on with GDP. In addition to that, we can see other macroeconomic indicators pointing to the same thing. So namely on this page, the industrial production, ISM manufacturing, and retail sales all started to decline actually a little earlier than GDP did. That's because these are all leading indicators and typically give an idea of where GDP is going. So you can see industrial production, for example, started to turn down in late 2007 all the way through early 2009 again. And it started to turn up a little bit before GDP did. It's the same story with manufacturing data and with retail sales. In addition, if we go over to the employment page around that same time frame, we can see the unemployment rate skyrocketing during that time. We all know that the Great Recession was kind of a product of the housing market collapsing. And you can see that here being demonstrated by housing starts and new building permits, where these numbers just plummeted through that time. In addition, you can look at credit spreads and treasury spreads to get an idea of fear in the market and the likelihood of default on corporate bonds and U.S. government debt. So you can see the 10-year high yield versus 10-year U.S. Treasuries really spiking during that time. And all this stuff will be addressed in future tutorial videos. So I encourage you guys to stick around to learn more about what all of these different pieces of the macroeconomic puzzle are telling us. But generally, they're confirming what was happening in the economy at that time and what was going on with the GDP growth rate declining. So all this information can be used to help inform our trading and to help us get a better idea of where the best investment opportunities are going to be, which sectors of the market are going to outperform and underperform over given time periods, and relative to which phase of the business cycle that we're in. So to recap, the business cycle just refers to the natural fluctuations in economic growth. It's comprised of 4 main phases. You have an expansionary phase, followed by a peak, followed by a contractionary phase, and a trough. Now we can use this information as investors and traders to help inform as to the current state of the economy and the likely future direction of the flow of funds through the various sectors of the stock market. This is going to help us to allocate our portfolios appropriately and to make better investment decisions. And again, I encourage you guys to check out the sector rotations video in order to learn more about how to apply the concept of the business cycle. So if you guys like this video, subscribe to our channel, hit that like button, leave any questions in the comment section down below. And until then, thanks for tuning in, and we'll see you guys in the next video.